Hello and welcome to this special edition on the eve of the Union Budget 2026. I'm your host Sandeep Rao, and this is an episode focused entirely on how markets behave around budget day and how, as traders, we can think about positioning ourselves. Union Budget is one of those events where economics, policy, politics, and markets collide within a single trading session. For those prepared, it's a day of opportunity, and for others, it's a day of heightened risk. I know it can be a crazy day in the markets. Headlines are flying, expectations are running high, and every sector seems to have a narrative attached to it. But if you're anything like me, someone who lives and breathes the market, budget day is impossible to ignore. In this episode, I'll walk you through how markets have behaved historically around union budgets, what actually matters versus what's just noise, and the kind of trading frameworks that make sense in this high volatility environment. Our focus would be more on understanding the market structure, volatility, risk, and possible opportunities. So whether you choose to trade or stay out altogether, do it with intent. With that context, let's get started. As I always do, first things first, what exactly is the union budget and how is it different from an interim budget? And why does it happen on the 1st of Feb? The union budget is the government's full annual financial statement. This is where key fiscal policy decisions are taken, from the government spending and borrowing plans to direct and indirect tax changes. These are decisions that shape how the economy, corporate earnings, and markets evolve over the next year. An interim budget, in contrast, is presented in an election year and is largely a stopgap arrangement. It usually avoids major policy or tax changes and focuses on continuity until a new government presents a full budget. That distinction is important for markets because full budgets tend to carry more information, more uncertainty, and possibly more volatility. You see, the budget is presented every year on the 1st of February. Historically, it used to be presented at the end of Feb, but this changed in 2017 to allow for a longer window of time before the start of the new financial year in April. In this episode, we'll approach the budget day using data-driven insights. In fact, one of the interesting patterns we'll see later is that budget day market moves tend to emerge more clearly in the second half of the day, something the data highlights quite consistently. A couple of disclaimers before I start. This episode is strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in the complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in future. Also, a basic understanding of options and derivatives is assumed to fully follow the concepts discussed in this episode. With that, let's start with looking at how the broader market performs before and after the budget day. Take a look at this bar chart showing January returns since 2019. The median is actually negative. That said, this is a small sample size of just about 7 observations, so it's important not to overinterpret. Now we move to Feb. The picture doesn't improve. Feb returns are weaker than January with a median close to -2%. So from a simple calendar return perspective, there isn't much of an edge here. And on a lighter note, it does seem like the Indian markets are rarely in a celebratory mood around the budget. Perhaps it's the uncertainty, the lack of clarity on policy, taxes and spending that pushes both investors and institutions to reduce risk ahead of the event, resulting in negative returns in January and February. Or perhaps there is no single explanation at all, and as they say, sometimes the most honest answer in markets is simply that there is seldom one single reason to what happens. Next, let's move to INDIAVIX and see how the market prices volatility ahead of the budget. I have covered the last 9 union budgets, including 2 interim budgets in 2019 and 2024 as a part of the dataset. What I've done here is to look at 5 different pre-budget time windows. The first is 15 trading days before budget day, or T minus 15 to T minus 1, meaning up to the day just before the budget, shown in the light blue bar. The second is 10 trading days before the budget day, shown by the darker blue bar. And then we have 7 and 5 trading days before the budget day, represented by the yellow and red bars respectively. The core idea here is simple: to understand how option traders price in volatility as the event approaches. What stands out is the larger time windows are far more consistent than the shorter ones. If you're looking to capture a gradual build-up in volatility, the T-15 and T-10 windows offer much more reliable signals than the last few days heading into the budget. Traders can use long volatility or long Vega strategies like long straddles and long strangles, as well as debit spreads, long calendar spreads, and diagonal spreads, which benefit from the rise in implied volatility ahead of the event. To get a better sense of the odds of volatility expansion before the budget day, I tested a simple positional strategy. The idea is to deploy a long strangle with strikes 2% away from the spot. Entry is at T-5 at 9:15 close and exit is at T-1, that is the day before the budget day, at 15:29. There is no stop loss applied in this. As you can see in the table, there are years where it worked quite well, but it's not as consistent. Perhaps it works better on a longer window. We don't have that kind of a time this time around, so perhaps next time. Next, let's look at the budget day percentage moves in NIFTY versus INDIAVIX measured from the previous day's close to the budget day's close. One thing becomes immediately clear. Regardless of whether NIFTY moves up, down or barely moves at all, INDIAVIX almost always closes lower on the budget day. In other words, once the event risk is gone, implied volatility tends to compress. A classic case of uncertainty being resolved. Next, let's move to some intraday statistics. One of the key considerations when trading short straddles or strangles is the extent of the intraday move the market can make. To gauge that, let's look at the intraday range of NIFTY and INDIAVIX on the budget day. For NIFTY, the intraday range on budget days has varied from 0.8% to as high as 4.9%, with a median range of roughly 2.07%. If you're deploying short strangles, this range becomes a useful reference point. It helps in deciding how wide your strikes need to be in order to absorb typical budget day moves without getting impacted. While continuing on the intraday time frame, now let's go one level deeper and look at the budget day behavior from a rate of change perspective. What I've done here is split the trading day into two sessions. The morning session from 9:15 to 12 and the afternoon session from 12:01 to 3:30, and then calculated the price change for each session separately. Once again, there isn't a strong or consistent pattern. Mornings have tended to be slightly more volatile than afternoons over the past couple of years. But that's not something I'd read too much into or try to build a rule around. So far, we've looked at how NIFTY and INDIAVIX behave across months, weeks, and on budget day itself, which gives us a reasonable sense of the market structure around this event. The most consistent takeaway is clear. INDIAVIX tends to build up into the budget day and then collapses soon after the event risk is removed. The natural question then becomes, how do we translate this understanding into simple rule-based trading setups? For now, I'll focus purely on intraday setups. Here's the first hypothesis I tested. Sell an at-the-money straddle at fixed 15-minute intervals and evaluate how it performs. The objective is to see whether certain intraday time windows consistently offer a better edge than others. We'll explore two variations of this setup. The first uses a fixed stop loss of 20% on each leg of the straddle. If you simply look at the win rates, two time windows stand out: 10 to 10:30 window and the 11:15 to 1 o'clock window. These periods show relatively better consistency compared to the rest of the trading day. So if you're considering deploying intraday straddles on a budget day, these time windows may be worth paying closer attention to. Next, we repeat the same exercise but with a combined premium stop loss of 20% applied to the total straddle premium. Under this stop loss structure, the 10:30 to 12:15 window appears relatively better than other periods. However, when we step back and compare across approaches, the fixed leg-wise stop loss setup performs more consistently overall. This suggests that a combined stop loss may struggle to absorb intraday volatility on a budget day. As a result, it tends to exit trades more frequently compared to the fixed stop losses on individual legs, especially during sharp, two-sided price moves. Now, some of you might wonder why not try a long straddle instead. That was tested as well, and the results are consistently poor. Here's both fixed stop loss, long straddle with 20% stop loss on both legs, and then a combined stop loss, long straddle with 20% stop loss. With the exception of an outlier around 2:45 window on fixed stop loss and 1 p.m. window on combined, almost all time windows show negative performance. In practical terms, this suggests that long straddles struggle across nearly every intraday entry point on a budget day. This also aligns neatly with the theory. Budget day is typically characterized by a volatility crush once the event risk passes. And long straddles, which rely on sustained or expanding implied volatility, are structurally disadvantaged in such an environment. In summary, if we look at index price action around the budget day, the calendar bias for both January and February has been mildly negative. That said, irrespective of the index direction, the build-up into and subsequent collapse of INDIAVIX around budget day remains one of the most consistent features in this data. Now, against such a backdrop, short volatility strategies generally make more sense and tend to offer better odds provided trade timing and risk management are handled carefully. It's not that long volatility strategies have no edge at all. It's just that they are harder to time and more difficult to extract consistent profits from. By anchoring our approach to volatility behavior and by being selective about intraday time windows, we can tilt the odds marginally in our favor. One word of caution though. Statistically speaking, we are working with a small sample size here, so all that I shared with you should be taken with a good dose of skepticism. And finally, this year the 1st of Feb falls on a Sunday. If market opens as they have in the past, only then this analysis holds. Let's see. I hope you found this analysis helpful. Do let me know in the comments if you have any questions. I will try my best to answer. Until then, stay sane and trade safe.